Gold prices are soaring. You may have heard they've hit all-time highs, keep registering all-time highs all throughout 2024 so far. What many people want to know is what's behind this gold price move, and more importantly, will it last? Who better to bring in to answer these questions than monetary metals himself, Mr. Keith Weiner. Keith, thank you very much for joining me here at Eurodollar University. And just before we get to those questions, I wanted to say this is one of those interviews that's as much for me as it is for the audience. I love talking to people who have first of all, a deep abiding passion for monetary topics, which describes you to a T, but also your depth of knowledge and history, which is incredibly impressive and incredibly useful at times like this. So thank you very much for joining me. Thank you very much for showing up for Eurodollar University. I really appreciate that.
Thank you.
So let's start with that. Gold prices, right? Gold is going higher, registering all-time highs throughout 2024. What do you think is behind this major move, and why now?
You know, how do I even begin with that? The TLDR version of it is, I believe gold's in a bull market again. We're not in, the sideways to bear market of 2012 through, 2018. I think that's over. That was a sell the blips market. This is a buy the dips market. And, you said gold's been making all-time highs. Obviously, the last several weeks, it's come down. Up today, as I say this, I think about 1%. But I think there's a durable trend here, and I say that for several reasons. When you look at the monetary system, and you and I think, share a perspective that it's a dollar system, and all the other currencies are. I think of them as almost like company coal mining town scrip. You could imagine there's some town in West Virginia, circa 1870, where the good townfolk believed, perhaps some of them believed, that their local company scrip was going to displace the dollar in some way. Maybe they even had conversations around the pub at night over that sort of topic. But, if you look at it a little bit, you zoom out and look a little bit more objectively, you can see how, ludicrous that is. I think all the other currencies are dollar derivatives anyways. And, but the dollar really was, and in a certain sense is still today, a gold derivative. So I think it's perfectly appropriate to price all the other currencies in dollars. And then ultimately the dollar has to be priced in gold, not in consumer goods, and certainly not in euros, which is what the DXY mostly is. And so if you flip it and say that it's the dollar priced in gold, not the other way around, that actually resolves a really interesting dilemma that I remember hearing several prominent speakers over the years. One that comes to mind is Grant Williams. I don't remember which conference it was, when he said that normally in times of crisis, it's the bid that's withdrawn. But in the coming monetary crisis, it'll be, and for gold, it'll be the offer that'll be withdrawn. I remember thinking, well, that's interesting. That's kind of like retrograde motion for the planets. Only necessary if you're trying to cling to a theory that isn't really right. And if you have to hold that theory, if you have to insist that the planets and the sun are going around the Earth, then you have this retrograde motion problem to deal with. If you have to insist that the entire economic universe, including gold, is going around the dollar, you have to deal with this issue that the offer on gold will be withdrawn. And everything else he said was very astute, and I basically agreed, except for that one thing. It's like, well, how do you explain how planets move backwards in their orbits? How do you explain how the one thing in the economic universe withdraws its offer? But if you look at it as gold is actually the base money that's bidding on the dollar, and ultimately what gives it its value, and then in that crisis, gold will withdraw its bid from the gold perspective, which people in the dollar bubble will perceive as the offer to sell gold will be withdrawn. Then suddenly things become much simpler, and so I think William of Ockham would be pleased as well, by that approach. But anyways, all of this is by way of background to say the fiat currency system, or what I call the regime of irredeemable currency, is taking another leg down. And it's not that hard to guess why. Most people focus on the quantity of the stuff, which is certainly increasing at rates that are alarming to many. But I would call myself an adherent to the quality theory rather than the quantity theory of money. And the quality of the stuff is taking another leg down. When you look at the abuses that are more and more open and dare I say brazen. I mean, in the United States, you have a president. So first of all, we're just setting aside all the institutions of governance, the fact that there's a division of powers, or was, and you have a president saying we're going to forgive student loan debt. And, it's not that the amount of it, I mean, compared to everything else that's going on, what is it, $1 trillion he wants to or did set aside. It's not the $1 trillion itself that's necessarily the big problem, but the president all of a sudden just decreeing that he has this power to do this, and directly attacking the monetary system because, currency is backed by ultimately the power of or the capability of the debtors to pay. And the more that the government spends on that doesn't produce an asset that generates a cash flow, the more that ultimately it's headed to crisis and collapse. And so, that's a big step, not only in the quantity of it, but more importantly in the brazenness of it. And obviously, if he can do that for student loans, what else? Is there anything he can't do? And what's coming tomorrow? And then you see in the banking system, I mean, one of the big things, this is obviously an old story now, was the failure of Silicon Valley Bank. We just had another one, I don't remember the name of it, last week, that failed. Republic First. Yeah, that's why I was like, wait a minute, I wanted to say it was Republic something, but that one was an old one. So any bank with the name Republic in it, I guess beware. Just kidding. But, clearly there's a lot more banks that are in that same exact boat. In 2020, the deposits flowed in. They had to put those deposits into something. They put it into 10-year treasuries, and then because that was monetary policy, the banks were encouraged to do that. I had Daniel DiMartino Booth on our podcast, and I was talking about monetary policy in summer of 2020, and that the regulators, at the very least, tacitly, wink, wink, nudge, nudge, you banks should buy this stuff. And I said, I kind of wonder, and I asked her if she would be in a position to know and be able to speak on the air, that would the regulators have ordered the banks to buy the treasury paper? Because, of course, banks are they're not just regulated. It's not just like, okay, tell us what you did and file a form and get audited. They're actually supervised, and the supervisors tell the banks what to do. And I said, do you think that the regulators, would have been telling, whether it's the Fed, the Treasury, the Office of the Controller of the Currency, somebody, would they have told the banks, you must buy this? She said, well, and it was a very interesting answer. I don't think they would do it like that. In other words, it wasn't like a categorical, no, there's no way the regulators would pressure the banks. Just, well, it wouldn't be that overt and that, direct.
Well, they did remove the supplementary leverage ratio surcharge for Treasury and reserve holdings. I mean, that was at least the carrot. So it's not
Right.
hard to imagine that there might have been a stick behind it. I mean, they said,
Right,
look,
exactly.
we'll make your balance sheet efficient if you buy Treasuries, and maybe there was some
Right.
supervisory action on top of it.
So anyways, obviously a lot of other banks are in that same boat. And, the financial reporting for banks to the public is fairly opaque. A lot of people have written about that. Very hard to tell what is really truly going on. Another mystery, and I don't think you and I have chatted about this anywhere yet, so maybe today is a good day to talk about it, is, if you remember the Sherlock Holmes story, The Hound of the Baskervilles? And the big mystery was the dog that did not bark during the night. This dog was a real barker, and then there was a murder, and the dog didn't bark. And Sherlock Holmes was the only one who picked up on that, and that proved that, the murderer had to have been known to the dog. And so it wasn't who everybody assumed was the murderer. It had to have been, I don't remember who it was that actually committed the murder in that story anymore. But the dog that's not barking in the night right now is the spread between junk and treasuries. Why is that not blowing out? I mean, before interest rates were going up, the BIS was saying something like 20% of all corporate debt out there was zombie debt. And now, they moved rates from 0 to 5.5% effectively. Why, what percentage? I mean, if there was 20% was zombie at zero, what is the percentage now at 5.5 points higher? You just moved the margin. It wasn't a marginal move to the margin. It was a massive move to the margin. Obviously, there has to be an enormous number of companies that are no longer, capable of paying, and obviously, their access to, credit is also, far less generous than it was, in the halcyon days of 2020 and 2021. Why is that not blowing out? And so I have a golf buddy. We seem to get together about 4 times a year and golf. And, he's an investment advisor and does a lot of annuities for his clients. And so he had a chance to talk to the back office folks at one of the big insurance companies that sponsors a big annuity that he sells. And they said that the regulators have given them kind of, not exactly carte blanche, but kind of a wink, wink, nudge, nudge. We'll set aside the normal rules that, you have to reserve more capital if you buy a junk bond versus a treasury, and allow them to essentially load up on junk, which they're all keen to do because they're all undercapitalized. And,
That always ever present reach for yield, right?
Right, yeah, it's reach for yield, and it's what, 3.2%. I think the last time I had the conversation was 3.5% spread to junk, so you can recapitalize a lot faster, obviously, with that bigger spread, and that the regulators are openly, winking about that. And he and I just look at each other and like, that can't end well. I mean, these zombies are zombies for a reason. They can't repay. They can't even service the interest, let alone repay the debt. And to buy those bonds, it's completely nuts. Anyways, there's a leg down in the quality of the debt that's backing the system. And I think as people contemplate that, they, logically turn to gold. At the moment, for the past several months, it's not been a Western buyer that's been driving the gold market anyway. I think that's pretty well understood. I have a unique perspective.
Yeah. So what do you make of that? Because I mean, we've heard tons of stories about China. I mean, obviously India and some places they're constant buyers, but the Chinese have been heavy buyers over the last year or so, maybe a little bit longer than that. Does that suggest to you that something has changed about maybe the risk profile with the Chinese, or maybe just emerging markets in general, or is that a reflection of your idea of the dollar?
So I think that, and I have a different perspective, and I realize that other prominent folks are looking at this differently, which, it's a marketplace of ideas, have at it. My perspective, I spend a lot of time, traveling. I've been in Singapore a lot and Dubai, more. And Dubai is increasingly the hub of the physical gold market. And an awful lot of gold comes to Dubai and then goes out to various other markets. And I see 4 worlds where they're buying gold hand over fist. China's one of them, the others being India, Turkey, and the Arab world. And I see 4 distinctly different drivers for that. I think the Chinese are buying gold as much as they can. Now the Chinese government keeps imposing restrictions on how much they can import. So far too much is said about the premium internal to China versus, the London price. And that, now that's the true price. China, price setting has moved to China. No, it's just, if you restrict imports and there's demand internally, you'll open up a spread. This is just pretty standard understanding of markets. That's, the Chinese have impaired the efficiency of the market. They're not allowing it to clear, really. But why are the Chinese people buying so much gold? They don't trust the yuan. They don't trust the Chinese government, and they want an asset that's sort of not the yuan, and they don't trust they don't trust their stock market. They never have, and now increasingly they're not trusting their real estate market, which they were using real estate as a surrogate savings bank for a long damn time, and now they don't really trust.
It was their only savings. I mean, that was the primary
Yeah.
savings. I think, and it goes back to what, the primary allure of gold has always been its property. You own it. It's not a liability of someone else. And
Right.
so if you distrust everything else around you and there's no other place to turn, you put the gold in your pocket or buried in the backyard or just store it someplace safe. It's yours. And as the financial world goes about its business toward, moving toward destruction, or at least greater uncertainty, no one can take that away except by illegal, illicit means of force.
That's right. So, yeah, they've been turning to property for a long time, but there's a lot of signs of very unhealthy moves in their property market, and possibly a big crisis. One of the things I've always wondered about. I happen to have an American friend who's an expat living in China, speaks fluent Mandarin, married a girl who doesn't speak English. He's kind of an interesting bellwether for me. And his feedback is, you know, even the buildings that are occupied, the quality of the construction is completely different from what we have in the West, to say the least. And the maintenance is not the same either. So, you'd always be complaining on Facebook about one or several of the elevator banks would be down, for like months. And so, to the point where he's like carrying his groceries and bottled water up 22 flights of stairs to his apartment, that kind of thing. And, anyways, I asked him about, are the properties on the higher floors more valuable? He said, no, it's the other way around, because the elevators can be down for a long period of time and you have a long walk, up and down all those flights of stairs. So then I keep thinking
Is that
about,
something that you think has changed recently, though, that explains the sudden Chinese interest in gold?
no, no,
Because I
no,
think that these are long-standing
yeah,
issues so something else has convinced people that, maybe it's just the illusion coming off, and people are.
yeah, I think it's more that. So where we're going with that is they have all these empty buildings, not even necessarily the ghost cities, which they also have, but just, people, because they're using it as a savings account or attempting to use it as if it were a savings account, more precisely. What's the quality of the construction of those buildings and how much maintenance is going on there? You can only imagine the incipient crisis. Those buildings are all in a state of decay and rot, and probably unsafe by Western standards, many of them. And at some point, the Chinese have to become aware of that. Maybe they visit their property and they see the shocking state of rust or leaks or who knows what's going on there. But anyways, obviously, there are some big debtors that are in crisis. Evergrande is in the news, but I think there's a lot of other things. And it's those crises that, drive a lot of change at the margin. I think the Chinese people are buying as much gold as they can get, for that reason. Now, and the other recent change is President Xi is becoming much more authoritarian. And I'm sure it was predating this with his so-called crackdown on corruption. Important safety tip: when an authoritarian communist dictator says he's cracking down on corruption, that means he's cracking down on everybody he thinks is not loyal to himself personally. So there was the Communist Congress, the annual Congress, and then the previous premier, Hu Jintao, is sitting there, and then they have the Secret Service guys arrest him and I presume disappear him. And that was done on camera while Xi just, completely looks the other way as a signal of like, nobody's safe. We can get you, even if you're the former premier.
And what was shocking to me was last fall, Li Keqiang, who was the number two guy in China. He was retired and then suddenly had a heart attack. And none of the people who knew him thought he was in ill health. And I mean, yes, he was 60 some years old, and so people do pass away all the time at that age. But it was one of those. Was that really the issue here? And Li Keqiang was one of the rivals to Xi from the very beginning.
Right.
And it was like, is this really a message from Xi? Because it really seemed that way.
That's right. And so I think that's what's going on in China. Now in India, right, they always buy gold, and their currency is designed to go down against the dollar. And I think somebody was telling me, I haven't done the math, it's about 7% per annum over long periods of time against the dollar. And so they buy gold whenever they can. And if the harvest is good, they buy more gold. If the harvest is bad, they may have to sell some gold or at least pawn it. In Turkey, they may have incipient hyperinflation. And so those people are buying gold hand over fist. I'm told that everybody in Turkey who has any degree of wealth would have at least 10 grams of gold, and the average would have a lot more than that. If you walk through the Grand Bazaar in Istanbul, I mean, I must have seen 100 plus gold merchants, whether it's jewelry, bullion, coins, all of the above.
What's the quality of that? Just just a sort of a random question. Is it sort of the whole spectrum of quality?
When you say quality, meaning purity, or just mean the
Oh, just
design?
different forms. I mean, you're not talking about good delivery from London Gold bars here.
Um, and well, in Turkey, right? So to trade on the Borsa, which is their like gold, well, it's their exchange for everything, including gold, it has to be LBMA good delivery bars, and they have two LBMA good delivery refineries in Turkey. What you're going to see in the Grand Bazaar in Istanbul would obviously be smaller bars from those accredited refiners, plus a whole bunch of other things, and obviously the jewelry. I imagine most of these places are pretty harsh if you're counterfeiting it. If you claim this is 18 karat gold jewelry and it turns out you're lying, I imagine really harsh things would happen to you. So probably good, but I mean, I would certainly not trust it without trying to verify myself if I was buying it. Anyways, they also, just like China, have restrictions on how much gold they can import. But unlike China, um, that's a very chaotic. I mean, the markets there are chaotic. The people are, it's a lot more chaos there, and I think the controls are a lot more porous in terms of gold has ways of finding its way in um, to Turkey. Um, and there's an incipient hyperinflation there, so everybody is loading up as much as they can. Um, of those three I've just said, those are not anti-dollar plays. Those are anti-yuan, anti-rupee, and anti-lira plays. The fourth, the Arab world, that's the one you could argue is an anti-dollar play. Now, all the places that I've been certainly have been very friendly and welcoming to Americans. They're not anti-America, or at least not in that sense. But I think they don't like American monetary policy, of recent years or maybe a decade or two, and they don't like what the dollar is doing to their economies. So, meeting with a family office in one of the Gulf states, not UAE but a different one. Um, you know, like a lot of them, the currency is pegged to the dollar, and those pegs are stable. It's not like the peso in some Latin American banana republic where they claim it's 1 to 1. And there's no way.
Yeah,
These
and there's a
these
black market price somewhere.
these currency pegs are table flat for 20, 30 years. So I guess kudos to whatever currency board is running it. That part's good. But one sophisticated guy said to me, "Yeah, we have the benefit of dollar stability without the benefit of the low interest rate. In other words, it takes higher interest rates to maintain the value of the currency."
Peg. That's the thing. The work in maintaining the peg is the cost, and it's a hidden cost, but it's a tremendous cost.
Yeah, so capital projects get a lot less financing there than they do here because the interest rate's a lot higher. So I said to him this. So I met with the principal of a family office and his longtime friend and attorney who advises him on all this stuff. And I said, "So what's the attraction to holding the local currency versus holding the dollar? I mean, there's no upside. It's not like it's going to go up against the dollar, but currency pegs do snap every once in a while. When they do, they can do so quite violently, and so you have this downside risk. It's very lopsided." And they looked at each other. I said, "But you're just better off holding dollars." They looked at each other and looked back at me, and the lawyer said to me, "That's our strategy exactly. We only hold enough of the local currency for like 3 months of liquidity, and the rest is real dollars, plus gold." So that part of the world is turning to gold as an anti-dollar play. But of all four of them, that's the only one. The other three are anti-local currency plays. And so, the dollar continues to be the only real, choice globally, and the same thing in the Gulf anyway. If you're going to finance a major project, it's dollars. For all the same reasons. And so, anyways, we look at monetary metals. We look at when the gold price, especially when it moves, we look at the gold basis, which is the spread between futures and spot. And there's an awful lot that one can infer by studying that. But at its very simplest, there's a spread. There's futures and spot, and if the price is going up and the spread, the futures to spot is widening, it's obvious that the price action it's bidding up the price of the futures, and that's been the pattern 2012 to to 2019, let's say, when you see the price rise, you'd see that spread widen. And that's why it was such a no-brainer for me to say, look, this isn't durable. It's the speculators using leverage. And by nature, it's a very short-term play. It's either if the price turns against them, they have to liquidate because they're hitting their stop losses, or if the price goes up, they're going to take profits. And so, it'll go up and then, blip right back down fairly quickly. What's happened in this big move from, let's call it 2050 to 2400-ish, is that the basis wasn't rising. And if anything, it was maybe even coming down a bit. And so, now the last couple of weeks has been a little bit different, but once the price broke down, we did see a change in this pattern. But all during that time, we saw that spread either staying this way or maybe even compressing slightly as the price is going up, and that means the bidding action is pushing up, metal and not paper. So that's one reason why I think this is durable. And so we calculate we call it a fundamental price based on our model, that is attempting to back out. Say, okay, what would the price be clearing at if, all these people that can use great leverage in the futures market, and they can temporarily push the price this way or this way. So imagine you have two steel pins and a rubber band stretched between them. There's times when the market is pulling up on it, but there's a tension there that when you let go, it's going to snap back. And there's other times when the market is depressed, pushing down, and then if you let go, it's going to snap back up. So what if we backed out the actions of those in the futures market, by looking at the basis spread and how it moves when the price moves, comparing, interest rates. There's some depth to that model. What would the price be? And right now the price is hundreds of dollars above the market price. So suggesting that, there's durability here. Right. And right now Westerners are not only not buying, but, as we talk to bullion dealers, they're getting, sellbacks from the customers that, people want to take profits. Okay, so you've got a certain amount of that. But if the price holds durably higher, there's a point at which psychologically people reset. And now this becomes the baseline. And, if it goes under 2,200, it's cheap. And if it goes maybe over 2,500, it's expensive. But, it sort of ratchets up. And, that takes time, and the psychology of markets and all the technical people, the Elliott Wave people can tell you, probably more about the psychology than I can. But the demand is real. Because ultimately I think the quality is taking a leg down. I think it's more obvious.
Do you see the same thing because of gold's behavior in the face of interest rates, which suggests that the demand is there regardless of what's supposed to be gold's primary opportunity cost is? I know you guys pay an interest rate, but for most people who are holding gold, they don't get any interest return. And so there's always that seemingly intuitive relationship between higher interest rates means less demand for gold. And so if you're seeing real money demand for gold, despite the fact that rates are relatively high compared to where they've been over the last decade or so, does that reinforce this notion or reinforce your idea that there's really strong demand here for reasons that are not just the usual ones? This discussion isn't really about gold's price, although that's part of it. It's not just about 2024. As Keith and I were talking about, as we went further into this conversation, it's about money itself. It's about how, for so very long, nobody wanted to talk about these things. We just accepted the way things were because that's the way things were. But now in the 2020s, many people are realizing we need to have a conversation, a deep conversation about the issue of money. And that there is a whole wide variety of opinions, of alternatives, gold, cryptocurrencies, properties that we really want to identify and try to replicate as close as we can. We really got into some of the deeper weeds here, Keith and I cannot thank him enough for stopping by with Eurodollar University. And if you want to see the rest of that conversation, it's only available to Eurodollar University members. And if you want to become one, there's a link in the description below. And there's a number of benefits to being a Eurodollar University member, including question and answer videos, weekly recaps, classroom videos on how the Eurodollar system actually works. I just did a couple basics videos, the basics behind, get this, QE and QT. We talk about bank reserves, what they're really for and what they really do, and a whole lot more at Eurodollar University's membership. So if you want the rest of the discussion with Keith Weiner, and it was really good, one of those that I enjoy as much as you might, then check us out, eurodollar.university, and become a Eurodollar University member. Until then, thank you very much for joining me. We'll see you again next time.